Stocks can be tricky, and once you add a few components to them, they can become confusing altogether. In this tutorial, you'll learn what call options are, a few key things to remember about them, and a few definitions so that you'll be able to talk just like a pro. A call option is a contract between a buyer and a seller of the call option to exchange a security at a set price. In this example, we see that stock A is currently at $150. We want the stock to arrive at a strike price of $185 so that we can what's called exercise our contract, right? And exercising the contract basically means to sell it. A contract is equal to 100 shares, right? So when you're dealing with stock options, we need to remember that each contract we buy, it has an equivalent of 100 shares inside of it. Now, you're not buying these shares outright, which is how come you see that stock option contracts sell for a cheaper price than, let's say, a stock may sell for on the stock market. In this instance, one contract is selling for $1 per share. But because we know that each contract has 100 shares inside of it, then we have to multiply the $1 per share in this example by 100 shares, giving us a total cost of $100 per contract. The cool thing about options is that once they arrive at the number where you agree for it to go, and in this case, the stock has to travel from $150 to $185 before you're able to exercise it. When a stock reaches that number, and this is my stock market representation here, and when the stock reaches the number in which you want it to go to, and you're able to now sell, you can now purchase shares if you wanted to of the company at the price in which you agree on, no matter how high the stock goes up in value. So in this instance, this stock went up to $200 per share, but we were able to cash in and buy at the agreed upon strike price of $185 per share, therefore making a gain off of each sell or each share that we have purchased in the market. Pretty cool, right? And even if you don't exercise the option to buy the shares, you can still just sell the option back on the market to make a profit. Pretty cool, right? A call can be long or a call can be short. Simply buying or holding a call is considered a long option. Conversely, selling or writing a call is considered a short option or a short position in this case. Think of it this way. For every buyer, there's a seller. If you're buying, you're long. And if you're selling, you're short. I wonder if that saying comes from the financial field. Don't sell yourself short. Now that you understand that part, let's go over covered calls. Let's say you brought into a stock and you wanted to protect yourself against the downside. That is, you wanted to protect yourself from the stock going down. You could sell a call, and in this instance, that stock will be a covered call. The reason it's covered is because you actually own the underlying stock in which you're trying to sell. For the more advanced option traders, you understand that selling a call is the same thing as buying a put. I explain more about puts in my next video, so stay tuned for more content. I think it's important for you to understand two more concepts before this video ends: in the money and out of the money. An in the money option is one where the strike price has been met or surpassed by the current number that the strike price or the stock is currently at. Usually, an in the money option will have a higher price you pay or premium because of its intrinsic value. This means that it doesn't have to actually go to the number that you're choosing. It's already been there. At this point, it will be considered at the money. At the money meaning that the price is exactly at the number where you want to get in at, or 1 point or 2 points above or below that number. Out of the money options are usually more desirable than in the money options because they're a lot cheaper. This is due to their extrinsic value. Basically, what this means is that because the stock has to travel to a number where you want it to go, this value will be considered extrinsic because it's outside of the realm of any number that is already surpassed currently. Because of this, the price of it is going to be a lot lower because you're taking more of a risk by hoping that it gets to that number. So because of the risk you're taking, it provides volatility, which offers a higher percent gain in the instance when you win, but it can also be a percent loss to the downside if you lose out on the bet as well. All right, what you see here is in the money. Okay, so what we're looking at is a chart that shows the trajectory of a certain stock. It could be stock A or whatever you want to call it, and you see the strike price is at 210, and you see numbers going up above 215 and 220, right? And in the money, strike price will be one as where this shaded area would be all in the money because we're making a call at the strike price of 210, right? Saying that it's going to hit 210. That's the call. So any number that it already surpassed would be considered in the money because it doesn't have to reach the number. It's already reached it, right? At the money would be in or around the strike price where you're choosing. So 209, 210, 211. This is called at the money. So this is saying that if you were to purchase it, you would be basically at the money. Out of the money would be the numbers above 215, 220, 225, because if you make a call at 220 or 215, you're hoping for it to go there. So this is where the value turns extrinsic because it's not inside, it's not a value that's inside basically of the chart or the trajectory of where the stock has been already. So this value becomes extrinsic once it gets up here. The value of the stock is intrinsic or within, right, when it's down here. In any event, there's cases where you would want to use one as opposed to the other. Make sure that you study the market before you put a strategy into play. Also, be sure to tune in to my channel for more fire content and make sure that you like and subscribe so that I can continue to bring you the newest, most hottest information in the market, okay? Thank you for watching. I appreciate your time.